Oh, we want some money. We want it quickly, Dominic Alafaci. How are we going to get it? Let's find out in the next 15 minutes or so. Good to see you, Dominic.
Darren, how are you?
How was the situation overnight?
We're not going to believe this. There were some really positive job numbers coming out of the US. They grew twice as much as economists expected in the month of May, and the market fell. There was a couple of reasons why, obviously, the escalating Middle East tensions, but there's a chance that interest rates are going to rise because of the booming economy. It doesn't make sense, does it? No. So the market falls. And also I think the semiconductor rage of people just buying everything for AI and all that other stuff was overdone. So it's corrected about 4%. So quite a big fall on the NASDAQ last night. The Dow dropped 1.5% and the S&P 500 was over 2.5% lower. Across the Atlantic, London's FTSE was basically steady with the French, German and Italian bourses all lower. Gold fell 3%. It just, again, doesn't make sense. It's usually a store of wealth. Things looking bad, crisisy. You buy gold, gold just fell. So,
just fell by what, 3%?
Yeah, so that's still at $4,365.30 an ounce, so it's not cheap. And West Texas Minute was also lower. So work this out. The Middle East crisis is supposed to be worse, but the price of oil just went down. Really confusing time for people. If you're not used to this stuff, have a Bex and a lie down because it is a bit hard.
Yeah.
And the $A was lower against the greenback, is currently buying just over 70 cents, with the ASX 200 SPY lower about 117 points following Friday's effort, where our market fell 61 points to 8,625. So normally the SPY says what's going to happen on Monday, but because Monday's a holiday, we'll have to wait till Tuesday to see how our market opens.
Okay. Give us a ring, 133 693, if you have any questions for Dominic. Chris has called through. Good morning.
Good morning, Dominic and Darren. Thanks for your program.
Sure. Pleasure.
I just wanted to ask a question about superannuation, if I may.
Go ahead.
I'm 61 and my husband's similar, getting close to retirement.
Yep.
And I'm just working casually, and I mainly earn through interest about $50,000 a year.
Yep.
Can you tell me, can I add some money into my super, and how much can I add in?
Chris, if you're earning $50,000 a year from interest, you are paying...
Oh, so about 30.
About
yeah.
30,
so
okay.
About 30 from interest.
Interest
and
only.
then about 20 from it. Yeah, and then about 20 from saving, and then about 20,000 from my casual work.
Yeah.
Just
well,
a
look,
little bit.
Firstly, if you're 61, there's a triangle I put on. Imagine we're at a whiteboard and we do a triangle. I say let's say your total wealth is $2 million or $700,000 or $50 million. It really doesn't make any difference. You draw the triangle and you draw a little line under the top. That's your home. So that's the best investment you can have, and it's tax-free. So if you've got an $800,000 home or an $8 million home or somewhere in between, pay that off as quickly as you can.
Yeah, we've done all of that,
Perfect. Chris, the next line is super. So every person can have up to $3 million in super by the time they retire. Sounds like a lot of money, but in a few years' time, it's not going to be that strong. So fill up your super bucket second is the general rule. Then after that, you've got companies and trusts with tax. If you invest in a company or a trust, through a company or a trust, I should say, they're effectively wiped out now under the new Labor government's rules that are hopefully, maybe they'll get knocked back.
When we were lied to by the Prime Minister.
Oh, yes, we were. And the bottom one is tax-paid bonds. So if you've got a lot of money, we're talking in the millions, you use the fourth one. Our advice is pay off their home and then put everything you can once you've attained 60 years of age into super, because it's the
How much are the limits is what I'm wondering about putting money into super.
There's two limits. There's the concessional contributions where you get a tax deduction, and they start from about $27,000 a year up to about 30-something thousand a year. And most people can put up to $175,000 in one hit and get a big tax deduction if they haven't made contributions over the last so many years. So that's a cap you can use. If you use 20,000 of it, you can put 155 in. That's for people who've, say, sold a property and they've got a capital gains tax problem. You can wipe a lot of it out through concessional contributions. The second thing you can do is make non-concessional contributions. Now, if you started today, you could put in $510,000 between now and the 2nd of July, each person, which is $120,000 and then 3 lots of $130,000 on the 1st of July. So you've got plenty of scope to get that money out of the bank and into a tax-free environment, Chris, and I'd suggest you get some personal advice. If you need to speak to me, go to collinshouse.com, click on the Contact Me button, write me a little note and I'll contact you to see if we can help.
Great. Thank you so much.
Good on you.
Very good. Thank you.
You're on the right track there, Chris, by the sounds of it.
Well done.
Yeah, getting stuff into super. To Gary, good morning.
How you going?
Yeah, good, Gary.
How can we help?
Yeah, I've got 2 questions, if I may.
Yep.
When does the tax-free threshold cut in? I'm not working. I'm just for my interest.
So if you're talking about your personal taxation, the first $18,200 of income of any sort.
Tax-free.
Yeah, and then between $18,201 and $45,000, you pay 16%. And then this is if you're a resident in Australia. And over $45,000, it goes up to 30%. And then over $135,000, it goes up to 37%. So you got the first $18,200 tax-free.
Oh, okay. That's good. Thanks. The other thing is with my bank statements,
Yep.
the interest is added on
on
the 1st of each month. So will I, like the 1st of June, will that be the last lot of interest for this financial year?
Generally speaking, individuals use a cash basis for doing their tax. So you've got to receive the money in the bank, the interest, before it's taxable. So the 1st of July will be the beginning of the next financial year.
Good on you. Thanks, Gary. To Helen, good morning.
Oh, good morning. AMP has just put out a notice saying they will not renew term deposits after July 16, and I'm just wondering, is this normal and what to do?
Yeah, it's quite normal. We were talking about this last week, actually, Darren, where banks have their times that they want to buy money, so they offer a high interest rate to attract investors, and the investors deposit their money in the bank and then the bank lends it out. Now, AMP, in this particular part of the cycle, they're saying we don't want any more deposits. Because we don't want to lend any money out or they're full. So sometimes that can happen. So I wouldn't be worried about it. If you're looking for some good long-term investments, is it a short-term investment or a long-term investment, do you think, Helen?
I'm really looking at a couple around 11 and 6 months.
Okay. Probably the best thing I'd do is I'd use an at-call account because you can get 5.75, I think, who is it now? I think it might be Rabobank, even higher. They have a honeymoon rate.
Judo's higher than that, actually.
Is Judo 5.9, is it?
That's 595, I think, for 11 months.
Yeah.
That's pretty good.
It is pretty good. There are some bells and whistles, though. You've got to qualify and do... There's some terms and conditions, but they're probably a better rate than the longer-term deposits because they're in the 5s. 1 or 2 years, you get a little bit less. So the yield curve is sort of pointing up towards the shorter-term end at the moment, so that's where you're probably best placed to invest your funds.
And are all these places safe?
They're all government guaranteed.
Yeah.
Because every approved deposit-taking institution, up to $250,000 per person per company. So if you've got $2.5 million, you can put it into 10 $250,000 investments, and the government is the underwriter at last resort.
I'll guarantee.
Yeah. But don't lose track of the fact people who put their money in term deposits for 5 and 10 and 20 years, they're robbing themselves. I mean, the long-term return from a growth portfolio, I know it's hard to tolerate the fluctuations because it makes you scared. In the last years, we're getting 15.21 net. And over the long term, we've got probably over 11%. So that's 2 and 3 times the term deposit rate over the long term. But you've got to ride the downturns with the upturns and not be scared. So don't put all of your money in the share market, but generally speaking, 8 to 10% is what you'll get over the long term, 8 years or more, whereas you'll get probably 4%.
4 or 5 for the term deposits.
Probably less, actually, because there were periods where you were getting a quarter of a bee's whisker.
Yeah, that's right. A bee's diaphragm, as Rex Hunt used to say. Yibba. Thanks, Helen, for the call. The lines are still free, 1336 693. And to Ian, good morning.
Good morning.
How are you, Ian? How can we help?
I'm just wondering, I've still got a mortgage. I'm 63, 64 this year.
Yep.
And I was wondering whether it's better when I turn 65 to draw money out of super to clear that mortgage and then focus on super from there.
Yeah, generally speaking, Ian, it is mathematically the best thing to do because the interest rate you're being charged on your mortgage, let's say it's 6%, that's after tax. So you probably have to go and earn 8 or 9%, and there's nowhere where you can invest at 8 or 9% with zero risk. So with your ears pinned back, pay off your mortgage.
Okay, that's fine. That was the question. I just kept thinking to myself, excellent, thank you for that.
Good on you, Ian. Thanks for that. To Nicole, good morning.
Hi, how you going?
Good, Nicole.
I've got quite a bit of savings, and my super's already pretty healthy. Should I be putting more into super?
How old are you, Nicole?
57.
57. Look, I would gradually do it over the next 3 years because once you've attained 60 years of age and you've stopped work, or a condition of release, you change jobs or something like that, you can access your super. So it almost becomes like a bank account. So I don't want to tie it up now because you might need it for something, but I would perhaps have a 3-year superannuation contribution strategy, get someone to tailor it for you. If you need an advisor, go to collinshouse.com. I'll contact you, and if I can't help you, I'll find you someone I know and trust who can.
Okay, thank you very much.
Good on you, Nicole. To Rose, good morning.
Oh, hi. Good morning. Just about superannuation, the limit's are $3 million. That's correct, isn't it?
Correct. Per person.
Yeah. So...
Oh, no, when I say that... No, sorry, the limit's unlimited, but it becomes toxic after $3 million because the government's introduced a Division 296 tax, which makes it horrible.
They want it.
Yeah, so up to $3 million, if you're fortunate enough to have that much money and own your own home, put it into super as best you can.
But you said about... Oh, sorry, tax-free bonds.
If you've got the tax-paid bonds, the effective tax rate is about 15%, which is much better than a company, which is probably 25 to 30%, and an individual be up to 47%. So if you've filled up your superannuation bucket, then any extra money, and I've got to be rude and ask your age, Rose, sorry.
I'm 65.
Oh, okay. If you've maxed your super, then you should consider tax-effective bonds. They're very old investments that have been around under the Life Insurance Act for many years. There's no life insurance in them, they're just investments. And if you go to collinshouse.com, click on the Contact Dominic button, I'm happy to send you some information.
Same age, Rose. Were you born in 1960?
Yeah, sure was.
Yeah, that's us.
Oh, you young buggers.
Yeah. Good on you. Thanks for the call. Dominic Alafaci, collinshouse.com, no AU. Click on Dominic and you'll contact him. That's the deal, isn't it?
That's absolutely right, Darren. Go Pies on
Go Pies for Monday. See you, Dominic Alafaci.